Perfect. So this week, what I'm going to do is it's going to be a bit of a revisit to a couple of weeks ago. I can't actually remember how long ago, but what we're going to talk about this week was the daily range and how we can actually find bias and entries based on the daily range. Now, yes, it's simple, but so many people go straight to entry methods without forming bias and without forming POIs, and they just get clapped so hard. And it's pretty obvious why when you actually zoom out and you look at the higher time frames. Now, you've got to understand that on the higher time frames, the 4 hour, the daily, the weekly, the monthly, that's where a lot of the big players play, because they've got higher time frame agendas. They've got longer term targets. On the lower time frame, so anything like 1 hour down to the 1 minute, that's going to be intraday stuff, and that's just algorithm based stuff. It happens on a daily basis, but on the higher time frame, you're going to have your higher time frame agendas. So let's say we've got a point down here. This is our starting point, this blue line, right? So we're starting here, and at some point we want to get up to this upper blue line, right? Now, on the charts, this span here, this span, right, that might be a few weeks, okay? A few weeks, few months. And price on the higher time frame isn't just going to go up in one straight line, okay? It can't do that because there needs to be a method for the banks to get in more orders so they can push the price to their target, okay? So what actually happens is we have impulsive moves, retracements, etc. Basic market structure forming until they hit their higher time frame target. And then once that's hit, they either decide to go higher or decide to reverse from there and find a new target. So the idea is we want to understand this higher time frame institutional order flow so that we can actually get in on each one of these lows, each of these low retracements, and then ride the move up with fairly low risk and high reward. So you get in here with low risk and you've got all this upside reward, okay? Now, what you see some people doing is you see a move here, right? And then you've got a 4 hour break of structure and people are trying to short it from this level, right? And there's a higher time frame target up here, but they're trying to short it because they've only seen the smaller picture, right? And if you can only see the smaller picture, then you're going to get collapsed so many times. Okay. Another thing as well is understanding fundamentals. That's important because then you can catch even bigger moves. You can catch the moves which are 300 to 800 pips, and they really do pay, especially if you're on a smaller account. They really do pay. So the idea of this daily framework is we're finding each of these ranges on the way up. My drawing's terrible there. We're finding each of these ranges on the way up, and we're finding some form of optimal area to entry so we can ride it up. But we're going to get lower time frame entry at this point, right? So basically, we want to find the market structure first, and that's going to be either higher highs, higher lows, lower highs, lower lows. Okay, we want to identify weekly points of interest as well. So because we're on the USD CHF at the minute, this is a great example of something that's just recently happened. And this is actually a trade that I believe Max Rawson took. So shout out to him because it's a banging trade so far. Hopefully he's taken some serious profit off the table. But the idea of this framework is, okay, let's say we've got this as the entire picture. Get rid of this as well. Get rid of my HFX oscillators as well. Let's say we've got this as a higher time frame picture, right? And right now, price action is like that. Just from this area, we can see we've got a lot of imbalanced price action up here. Price likes to fill imbalance, or it likes to run liquidity. It moves from liquidity pool to liquidity pool. So the chances are we're going to want to fill some form of imbalance up here. On a weekly time frame, we do have an upwards candle up here, right? So that might well be our overall target there. Right, let me just move price on. So we've got a potential overall target. We do actually have a bit of imbalance above there. So realistically, I probably want this imbalance to get filled, plus that lines up with a daily candle as well. So I suppose highlighting that as a point of interest to potentially move down from or have some form of retracement. When we look at the rest of what price action is doing at this current point in time, okay, we can actually see that we've had some form of impulsive move. We've got a bit of a retracement back into some form of area here. And then since then, we've just been following some form of order flow to the upside, right? And all we're looking for now is we're looking to find a high point, a low point, a break of structure, like so. We've got high point here, low point, the high point. This is our break of structure. That's all we're looking for on the daily time frame. This low point is going to be comprised of at least 2 down candles in this area. So 1 down candle, 2nd down candle. If it's just 1 down candle, it isn't really a swing point. So ideally 2 down candles as a swing point. Upside break of structure. And then all we're looking for is some form of premium retracement down into a daily point of interest. Okay. Is everyone with me so far? Drop me a message in the chat if you are with me. Perfect. Really, it's really not that difficult to understand, right? And this is why it's so powerful as well, because the framework is so simple. That's all it is. And then what we wait for is we wait for price to get down into our point of interest that we've identified. Okay. What we actually do as well is once we've got a daily point of interest, we can narrow it down to a 4-hour or a 1-hour point of interest as well. So a bit of refinement, just so we can be a bit more precise of when price is potentially going to turn around. Okay. So if we bring up our example here, make sure that's still in the shot as well. What we have here is we've got a high point, we've got a low point, and we've got a break of structure. Okay, so we've got a candle body close above this high. So clean break of structure, and that leaves us with this low and this high, which is this low, this high there. And that is our daily trading range. Okay, so at this point, let me just get rid of all this stuff. At this point, we want to identify our daily point of interest. Okay. Now, this is going to be an order block, ideally, institutional candle. So last down candle before the up move, it breaks this structure. So we've got our break structure up here. We've got up candle, up candle, up candle, up candle, and then we've got this last down candle there. So just going to highlight that out as daily point of interest there. Perfect. We've got a higher time frame target as well, which is also key. One thing as well, notice how we've got 2 down candles in this example. It's not perfect. It's not the best example, but in here, we've got at least 2 down candles to form this swing low. So that's valid. Okay. And then we want to go on to the 4-hour, see if there's any interesting points on the 4-hour. Right here, it looks like price has been mitigated completely. So it might not be the best picture on the 4-hour. If you look at every single one of these down candles before a significant up move, they're all mitigated. So just drop down onto the lower time frames and you can actually see a few more candles. So what it looks like here is we've got an unmitigated candle down here. We've got a bit of imbalance before it as well. It's a pretty tight one. If I just zoom into this area, you'll see. Okay, so if we look at each of these individual candles, this has been mitigated. This has been mitigated. It's all been tapped into by the previous price action. We've got a run of this low, and we leave this candle there, which hasn't been tapped into by anything. It was close, but not quite. Okay, so that's a nice potential refinement. So all we wait to happen is we wait for price to get down into this area. And then we look at entry methods. Okay. And that's as simple as it is, right? Prices come down into that area. And at that point, it's actually made a bit of a rejection there as well. At that point, we want to look at entry methods. Now, if we look at entry methods, there are numerous different ways that we can actually enter a trade. While I get a drink of water, I want you guys to name as many entry methods as you know and put them in the chat. No, unfortunately, that doesn't work. Short highs and press buy. Accumulation, looks like. Lower time frame analysis. Break of structure. Yeah, cool. Fibs help. Candle patterns. Key level, distribution. Wick rejection, IC candle fill, exhaustion. Cool. So let's first of all, let's have I'm sure I saw a fib in there somewhere. So you can use a fib on this entire area. So if we go onto the daily time frame, essentially what we're going to be doing is using the fib to draw from low to high point. And this can just help with finding institutional areas and potentially confluence and entry. So what we do is something like that. And then we find a fib level which confluences an area pretty well. That's as simple as it is. It can just help those who are fairly new to sort of find a nice institutional area. So what that would look like on this would be, there you are, drawn low, swing low to swing high, wick to wick. And then, as you can see, that actually matches up perfectly with this candle there. So that's just another way to look at fibs. But onto entry methods. And you're gonna have to excuse me here as well because my throat is still knackered. So I'm just gonna have to like mute the mic and cough 1 second. Okay, perfect. Right. So candlestick patterns. This could be an engulfing. Submit something in. This could be an engulfing candlestick pattern. So we might have a down candle like so, and then the following candle afterwards is essentially going to engulf the entire range of this previous candle. So range of this previous candle might be from here to down here, might have a wick on it as well. So the range might be there to there. And as you can see, this candle next to it, significantly bigger than the prior candle as well. Imbalance helps as well. So if we've left some imbalanced price action within here that can get filled, that is also going to help because that just shows that there was velocity in this move upwards. So there's going to be some form of big money in that move. 1 hour time frame is good to see this on, but it's up to you to practice. Then we're going to have a look at what the other ones. Break of structure on a lower time frame. So break of structure might be as simple as price running down into the point of interest, setting a low, setting another low, and then having an impulsive move. And it's important this is impulsive move to the upside, breaking prior structure, and then we just look for an entry like so. So break of structure at this point, and then we look for an entry around here. Then we've got wick rejection. So that might be something where we get a candle that looks something like this. Okay, so we get a big old wick down into a point of interest, and then we close up high. That could be another potential way to enter a trade. And what else do we have? We've got wick off. So accumulation, distribution. Effectively, in a sense, what wick off is it's just running price down, stopping people out, and accumulating orders. Wow, my throat is really playing up today. So what that might look like is you might set some form of low. You might have a sign of strength and then another push down. And if you look at levels here, people are going to be buying when they see signs of strength, people are still going to be buying. And these are just going to act as like liquidity, people getting stopped out, transferring orders over to the banks. And then at some point, we're going to get a move up like that. We can look to enter around this area or actually right down here. But ideally, we want a confirmation that we can enter around there. Very similar for a liquidity sweep. So that might be setting a low, having another low set like that, and then moving off from there. Except this low here is going to have a wick down below. So we've wicked below this prior area, taking out stop losses, and we've closed above that area. And then we can use this as an entry. Is everyone following so far? Yeah. Perfect. And we might actually see, in this example here, we might actually see two lows get set. So this is actually fairly similar to your Wyckoff schematic, except these will just be equal lows, like so. Okay. So let's get on to an actual example. Okay, so this is a nice, interesting one. So we had price that it set a low down here. We ran out a low there with this big down candle. Then we had some more lows set in here. Actually, if we really zoom in this area, right? Nope, don't want to do that. Really zoom into this area, you can see what's happened. We've set a low in here, and this candle has come just below this low, wicked below it, and then moved off. Fairly impulsive move from here because we've left some imbalance, okay? And then you can actually use this order block here for entry. So let's just mark that out. Notice as well, we haven't actually broke any real key structure. There isn't obvious key structure here. The key structure to me would probably be there, and we haven't broken it. So we don't always have to break structure. I mean, maybe if you wanted to have a look at that as break a structure there, fair enough. It's all very different, but this is an area with it sweeping liquidity and making this impulsive move off with a bit of imbalance in there. That's a nice enough area to look to gain entry. So let's just whack that on there. Stops below low. You could either do this low or both lows. Press shift when using a trend line. Yeah, thanks, mate. But that line there was a drawing tool. Is Dobbin trying to call me out, saying that I can't use Trading View? I was just using brush tool there. All right, so you can see we move this risk reward tool along. So we actually tapped into that area, tapped into this down candle. You wouldn't have this risk reward tool or your entry directly on this candle. You'd want to account for spread. So add a couple pips here and there just to make sure you get in. And as you can see from here, once we've tapped into that, we just start to take off. Okay. That is an ideal entry. Now, if we look at what else happens around this, we can see some retail stuff. So maybe trend line. It's going to be some trend liquidity above there. See how perfect that is. Wick, wick, wick. Going to be some money above here. Maybe even if you wanted to do this. Something like that. I don't know. Maybe could be that. Who knows? Yeah, there's one. Short rejection and then boom, wiped out. So that is an ideal entry scenario as well. What happens within this area is we have lows that get formed as well. These lows just acting as liquidity pools. So that means when they get taken out, this move can be more explosive. Okay, these are people's stop losses. They get taken out, transfer of orders, and then boom. Going to read the chat. Found mate that it can just be impulsive after sweeping liquidity, not always breaking structure. Yeah. So this one wasn't a clear break of structure, but because we left this imbalance within that area and we moved impulsively away, we swept liquidity. That would be enough for entry. I suppose if you really wanted to, you could get down onto the 3-minute time frame and you could class that as a break of structure. You could class that as a break of structure. It's all personal preference, but it doesn't have to break structure all the time. It just has to make some form of impulsive move so that you know banks are in play. Okay. See if there's another example. Right, so this is an interesting one. This is still using the same principle, but this is where we have a daily swing point. So we get a move, create a short-term high, we get an impulsive break of structure, and then instead of actually respecting a point of interest down here, okay, this is another entry scenario. Instead of respecting this point of interest down here, what we do is we just wick below this low, like so, and then close above. So we take some orders, and then we move off from there. So let me mark this up. What about the shorting ones? What about the shorting ones? One, I don't know what you mean by that. No, that's not what I wanted to do. There you go. So let's look at this structure-wise. We've got swing point here. We've got 2 up candles. So that's key swing point. We've got a low here. We've got an impulsive break structure, shed load of up candles, and then we've got daily point of interest there. You could refine that down if you really wanted to, but we obviously know this example just taps below anyway. Or does it? Does it just create equal? Didn't even tap below, just created equal lows. Either way, the point is we've got not a complete, well, it's not completely respected any sort of point of interest down here. It's just tapped below this area there. And once it's, as soon as it's done that, so if I put a horizontal ray on that, there we are. That's clearer, isn't it? That's miles clearer. Let me get that on full screen so you can see that better. So we've got this low here. It's not completely respected this low. It's just taken that low out, and then we've moved off from there. Okay. I'm sure on the lower time frame here, you could probably see some form of accumulation, what have you, and then that being a spring potentially. What have we got here? We've got a nice impulsive up candle. So that's a rejection candle, and then some form of confirmation candle is quite big. It's a confirmation candle. If you really wanted to, you could enter off the close of that candle and then just put your stops below that. But for me, 36 pips is a bit big, so I'd want to look for some other form of entry. Maybe if we and see what's going on down here. Okay, this is quite a good one. So we've got there you are, equal lows in there. Equal lows get taken out by this move down. There's a break structure. Okay, so we've got the low that got created by this point, break a structure, move up, order block right there. Liquidity sweep, also liquidity sweep of a higher time frame as well. And then that's your entry on that one. So that just covers the liquidity sweep, break structure, what have you. Okay. Now I'm going to show you another example, and this is where it doesn't go to plan, right? So as you can see here, we have got what's labeled as a metric fuckload of liquidity, right? So we've got so many equal lows. Everyone's all decided that they wanted to retail buy this at the same level. And ideally, people would be wanting to target that as a downside target. I was looking for the same. We had, let me just get rid of this other stuff here. Make it a bit clearer. There we are. So we had this swing high, we had a break structure at this point, and then we had a swing low. So daily ranges here to here. And there was me thinking, okay, perfect. Look, we've got all this liquidity. We'll target that. Now, if it doesn't go to plan and you mark up your daily candle and then you refine it, understand that price can actually blast through that. It can then retest on the other side as a remorse candle and then move up. Okay, that's something that can happen. Now, if we look at this example, so we had 4-hour candle there, probably refined down a little bit. Yeah, so that was just a 1-hour candle. Get rid of that. And what we have here is quite an interesting one. So we obviously had a small reaction from this candle, but what we created at this point was really interesting. So we had equal lows there, and we see this big wick rejection sweeping the equal lows and then an impulsive move upwards, right? So let's say we get taken out, we get clapped out of that one. I got clapped out of this. That's all right. I entered at this point, and I got clapped out. It's all right. It happens. And we need to be able to adapt the next move, adapt to the next move. So we get this big old rejection, wick, sweep liquidity, whatever it is, then we get a move off. Now, if we actually look on this higher time frame, you can see we get a nice institutional candlestick pattern. Liquidity sweep, down candle, engulfing candle. Okay, if that happens, it's blown through the point of interest. That could be an entry, is almost sort of like a remorse entry, if you wanted to call it that. You can see we come down, next candle, fill in an imbalance, tap into that candle, and then we move off from there. Now, if we look at the higher time frame completely, let's just use this entire daily candle there. See if we can see anything. Yeah, so after we break out of this area, we can see some form of retest on that as well. Not really the cleanest, I'll be honest, but it's just about being adaptable. And if you see something like this, being able to try and capture a move up, you can actually see a good old breaker block formation. So if you went on the call the other week, here's a nice breaker block. We've got liquidity sweep. We've got move down, move up. Breaker block in there. All right, so see how we tap perfectly into that and then we rally off. That could be another entry, is a remorse entry. But yeah, it's about being adaptable and you've got to understand every scenario. So when we get this higher time frame structure, okay, understand that there's realistically 3 sort of scenarios that can happen. We can have clean rejection from our area, clean rejection, and we take out the high. Perfect. We can have equal lows or a purge of that low. So like a wick, like so. Before then moving off and hitting our higher time frame target up there. And then we can have a complete blast through of this area. And then a retest on the other side. Literally, as soon as it blasts through, closes below, we get a retest and then move down from there. Okay. Or actually, we can get a bit more of a move and we call it a breaker. So we get a bit more of a move through that, and then we have a potential point of interest as a breaker. So we understand there's 2 scenarios to the upside, 2 scenarios to the downside. So whatever happens, we can look to enter around a specific point of interest. It's just about backtesting your entry. Okay. I actually got in a trade on ADUSD. Seems to be retracing up. I took a shed load of partials off. I think it was around where it started rejecting, because if we have a look, we've got 4-hour candle here, and I wanted to take some partials off there. I think 80% of my trade is off, so that's around 5%. That's my weekly goal. Realistically, have your targets smaller because they are so much more realistic. I see people going for literal retarded targets like 15-30%. It's just stupid. Like, you're not going to get anywhere with that. You're going to do your own ass trying to reach for them targets, because it's not realistic. And then you've got people who are actually on the opposite side of that, and like or then people that are doing FTMO that aren't ready for it. Like, they're going to be entering trades, they're going to be getting 1% in profit and then closing profit off because they're scared. Okay, so understand that you've got to get your mindset right. Understand that we've got a long-term vision, and when you understand the long-term vision, you can submit to 5%, maybe 10% a week. Now, I've taken 5% from this. If I let the rest run to my downside target, that'll stick me 10%. I don't know, something like that. Anyways, it's not the point. Just be realistic with your targets. If you're doing FTMO, your mindset's the most important thing. Don't try to rush. Don't try to rush, because if you do, you'll just end up shooting yourself in the foot. If you cannot take £250 to £1,000, £2,000, then I don't think you should be spending £1,000 doing a challenge where you've got restrictions. Because if you can't do it without restrictions, you're definitely not going to be able to do it with restrictions. So basically, the idea of discipline is understand that we might have short-term pleasures, but if we're just going to go for them short-term pleasures, we're never going to get to our long-term dreams. So you've got to understand the bigger pictures, right? How do I do the numbers? That's just a fib tool. I just modified the fib tool. And for entry of this one, simply what it was, we got a sweep of this liquidity here. We had an engulfing candle, and it was a 30-minute breaker. That's all that was. 30-minute breaker block right there, entry on there, and away we go. Simple as that. But I think as far as things go, that's all I'm going to say in this call. Next week, I'm going to do another cover of the intraday profiles that I talked about recently. So be sure to plug into that one, and I will catch you all in the next call. Bye-bye.